Hi there, this is Greg King, and I wanted to talk a little bit about the importance of how to properly structure a mortgage to best meet your needs as a consumer and help you meet your financial goals in the future. So, oftentimes when a client comes to me, one of the first questions they'll ask is, what is your interest rate? And that's a very fair question, but my answer to them is, what interest rate would you like? When I work with my clients, I help them decide which interest rate to choose that's going to best suit their needs and help them meet their financial goals. So it kind of works like this. If you imagine a teeter-totter in a children's playground and you have interest rate on the left side and you have closing costs or discount points on the right side, if you choose what we call the par or the retail interest rate, that means that's just the going rate for the day. As you know, rates change every single day. They change a little bit one direction or the other. But if you take the interest rate that is the par interest rate for the day, that means that there's no discount points associated with it, but there's also no credit from the lender associated with it. So what some people like to do, the people that are long-term minded that want to realize long-term savings, is they'll actually buy down the interest rate. So they'll take that interest rate instead of the market rate, they'll buy it down. And what happens is they pay more upfront in what are called discount points. So you actually have additional fees to buy down the interest rate that are added on top of your escrow, title, third-party fees, and also impound accounts for taxes and insurance should you choose them. Now, the opposite is also true. Say you have somebody who just doesn't have a lot of money for closing costs and they want to minimize their upfront expenses. Or for the person who is short-term minded with the property or this loan, in other words, they don't plan on keeping it longer than 5 or 6 years, then that person is going to be better served by going with a little bit higher than market interest rate. And at the same time, the lender kicks back money towards your closing costs to minimize your upfront costs. So not only do you not pay discount points for the rate, but they give you money back to cover things like title, escrow, third-party fees, and even so much as impound accounts if you choose a high enough interest rate. Here's an example of a waterfall of interest rate options. Now, this is not meant to be an accurate rate quote. This is only for illustrative purposes, but this is kind of what it looks like when you look at a rate sheet that a lender has. And on the left side, you have interest rate, and you'll notice that they go up in eighth of a percent increments. So we start at 3.75 in this example. We go up to 3.875 to 4% to 4.125 to 4.25, and so on. Now, on the next column over, you're going to see the cost or the credit that's associated with any given interest rate. You'll notice that the lowest interest rate option is going to have the highest cost. And these are discount points. This example is 1.375% of the loan amount that you pay in addition at closing. So let's take an easy example. At an interest rate of 3.875 and a cost of 1 discount point, on a loan amount of $300,000, that would be a 1% fee or an additional $3,000 towards closing costs. Now, for those cost-sensitive folks that want to pay less in closing costs and they don't mind paying a little bit more over the long term, or if they're short-term oriented with this property, a higher interest rate is going to come with a credit back from the lender. So this is the opposite of paying a discount point. This is a credit from the lender towards your third-party fees and lender costs. So in this example, an interest rate of 4.375 comes with a credit of 0.875 of 1%, or $2,625 towards your closing costs. Now, the last thing I wanted to talk about are factors which impact either the cost or the credit that you receive with any given interest rate. The first would be occupancy. That is, whether it's your primary residence, a second home, or an investment property. The next would be your FICO score. Obviously, the higher the FICO score, the more favorable pricing you're going to get on your interest rate. The property type, that is, whether it's a single-family detached home, a condo, or a multi-unit property such as a 1 to 4 or 2 to 4 unit property. The loan-to-value ratio, in other words, how much equity or down payment you have in the property. Whether it's a rate and term or a cash out. When it applies to refinances, cash out is going to be a little bit more expensive of an adjustment to the interest rate. Whether or not you choose impound accounts to cover your taxes and insurance, that is, if your taxes and insurance are included in your monthly mortgage payment, or with no impound accounts, you pay for those bills on your own. If you choose no impounds, oftentimes it's a little bit more expensive for you. Finally, the size of the loan. If it's a conforming loan amount, that is under $417,000. High balance is above $417,000, and the cap on that differs by county, but in San Diego County, it's $546,250. And then above $546,250 in San Diego County is considered jumbo. If I can help you analyze which interest rate option is best for you, please don't hesitate to give me a call. I'll put together a total cost analysis that goes over each option and makes it very easy to decide which one best suits your needs. My number is 619-569-7522. I look forward to working with you. Have a great day.